Hi, I'm Christine Benz from Morningstar.com. Investors have been gravitating to passively managed alternatives at the expense of actively managed funds. I recently sat down with Daniel Wallick, a principal in Vanguard's investment strategy group, to discuss how investors can successfully employ actively managed strategies. Daniel, thank you so much for being here.
Pleasure.
So Vanguard has roughly $400 billion in active equity products overall. Let's talk about when you look at the success rate of active equity fund managers in aggregate, not just at Vanguard, in aggregate, relative to passive benchmarks. How do they do? I think investors generally have become a little bit disillusioned when they look at some of these numbers.
So the theory would suggest that the market cap is the midpoint between 50% of the assets outperforming and 50% of the assets underperforming. And that's true theoretically. Then you have to account for cost. So the probability of any individual manager outperforming is somewhat less than 50%. There's two real ways that the industry tends to try and measure this. One is on a count basis. So if you equate every fund equally and look at the probability of picking an active manager who will be successful, those numbers tend to be pretty low. Those can be 40, 30, 20%, depending on what market, what time frame you're using. The numbers are slightly better if you think about it on an asset-weighted basis. And that would make sense, right? Because the theory would suggest 50% of the assets before cost are outperforming. So the numbers are slightly better, but they're still below 50%, 50%, in using either of those measures.
So the asset-weighted number would also suggest the fact that it's a little better picture for active management. That would suggest that perhaps investors do a decent job selecting better active managers?
Yes. What's interesting, our look at the concentration of active management is it's very highly concentrated. About 12% of the funds make up about 75% of the assets. So people are pretty smart about picking active managers. Those larger funds tend to be lower cost as well, relative to the absolute aggregate. So I think that some of the headlines have been a little overstated about the negativity of active management. There's still hurdles, there's still challenges, certainly, but the probability of success is somewhat close on a pure numerical basis.
Okay. So you're involved in Vanguard's active equity lineup, and in your recent paper, you discussed some of the keys for investors who want to use active funds, the things that you should know if your goal is to use them well and have a successful outcome. So at the top of the heap, the first thing any investor looking at any sort of active product should think about is what are the costs of this product. And certainly our data at Morningstar would very much corroborate that finding, that if you're going active, go low cost.
Right. A lot of the work that we've done has said, let's look at ex ante. Are there any factors that we can look at that quantitatively help us identify success? And the only thing that we found, as you found, ahead of time is cost. Lower cost funds do, by and large, better than higher cost funds. Now, that alone does not guarantee success, even with active funds, but it is the one statistically significant factor that we can identify as helping investors.
And it's kind of a counterintuitive finding, I think, because we all live in a world where more or less you get what you pay for. But I think investors sometimes are surprised when I'll tell audiences it's actually a more important determinant, that low costs are a more important determinant than past performance. When we have looked at data on past performance, whether it's predictive of good future returns, we actually find that low costs are a better predictor.
So we looked at it relative to past performance, relative to size of the fund, relative to concentration of the fund, relative to age of the fund, all the factors that we could...
Manager tenure.
Number of managers, all of it. And the one thing we found that was predictive was cost.
Okay, so costs are a good first cut if I'm looking at active management. You say, though, you can't just stop there, that certainly all low-cost managers are not high-quality managers. So assuming an investor wants to winnow down that low-cost universe to the universe of funds where maybe they're worthy of further investigation, what sorts of factors should they focus on?
So we think you have to marry top talent with low cost. That combination is really crucial to thinking about success. So talent is a very qualitative assessment for us. And there are four major things that our team looks at when we look at finding a manager. Number one is who are the people doing it. Number two is who's the firm. Number 3 is what's the philosophy, and number 4, what's the process. Now, those are all things you can't really score on a numerical basis for a guaranteed success. You have to really, it's much more of a feel. So there's a long due diligence process that we use at Vanguard to go pick managers, and that's sort of the process we would suggest that any active manager or anybody thinking about hiring an active manager should consider. Who are the people doing it? Have they been doing it for a long time? Do they understand what they're doing? What's their investment philosophy? Do you understand what that is? What's their process that they use, and is it replicable? Is it something that they can repeat over time? And then what's the firm philosophy, right? What's the methodology and the style that they use, and do you understand that and feel comfortable with that?
So I think a question investors have, though, is how do I gauge philosophy? How do I gauge quality of strategy? And certainly on Morningstar, we try to shed some light on that question. But how would you suggest sort of the lay investor attempting to get his or her arms around that question? What sort of things should they be looking for?
So I think it's actually fairly challenging for any of us to be sitting at home with our Sunday paper and trying to identify, a successful active manager. It really takes a lot of time and effort. And I'll give you just the lens through which Vanguard does that. We have an entire group, the Portfolio Review Department, whose task is to hire our outside sub-advisors that we use. We use 30 in the equity space. There are probably 50 to 60 people around the world who do that full-time and have been doing that for 40 years. So that's a really big commitment. And through that process, they'll take multiple years getting to know managers before they hire them. So I just don't think it's not something that we can easily or part-time dabble in. You really have to sort of commit yourself to doing that. But I think what you want to look for is when you think about a person, you want to think, is this an investor or is this an asset aggregator, right? You want the investor type person, the person who really loves what they do. Howard Marks is a classic example of that. And then in terms of the firm, is the firm about investments? Do they allow the team to invest, or is it much more of a short-term transaction that they're looking for? You'd want to avoid anybody, again, who's just interested in growing the business as opposed to truly doing the management. And then philosophy. Can you understand what the manager says they're trying to do? Does it make sense to you? And do you think it's replicable? That's the key, right? Can they stick to it? Now, along those lines, we would expect that no manager is going to be outperforming all the time, right? We always say that there's no alpha. No manager is going to give you alpha every day or every week or every month or even every year. It could be multiple years. So you have to believe that the philosophy through the long period of time will work. Not that it's going to move around in the short term to try and always work.
So I want to talk a little bit more about that, because you say that that's really the third quality that investors should have is patience, that in addition to low costs and doing that screen on manager quality and strategy quality, that they should also have patience, because even very good managers have periods of underperformance. So let's talk about that. If an investor is attempting to determine whether an active strategy is even appropriate for them relative to just using a very low-cost index strategy for their portfolio, how would investors attempt to get their arms around that decision?
Sure. I think it's a great question. So, again, we talk about if you're going to use active management, 3 things need to be present: talent, cost, and patience. Talent's from the manager, cost is from the manager, patience is from us as investors, right? We ultimately have to be patient. Let me just give you one set of numbers that sort of prove that point. We looked at successful managers, looked at a beginning time period over 15 years of 2,000 managers who started. About 500 of those had some level of success. And of those, 98% underperformed for at least 4 years. And about half of them were underperforming half the time. So the only way we know somebody's successful is after the fact.
Right.
So we have to take that qualitative assessment we talked about earlier, use that, and then be patient through time, and at the end, be successful. Now, okay, so that's how you think about active management. Whether active or indexing is right. The way we think about it typically is indexing is a valuable starting point for all investors. Right? It's a beginning, it's the baseline. You can choose to use active management, but you have to be comfortable with its attributes. We talked about this before, right? There's going to be an inconsistent pattern to those results. You have to be comfortable with living with that through time to potentially do it. The other thing we haven't talked about yet, too, would be this consideration of taxes, right?
Right.
Particularly for a retail client, where's this portfolio going to sit and what are the potential tax implications of that. Typically, active managers have a higher tax drag than index funds. Depends on a variety of factors, but that's generally the case. And so you'd want to take that into consideration as well.
So for taxable account, you may be better off in some sort of index strategy and reserve the active managers for those tax-deferred or Roth accounts.
Absolutely the best approach to take, right? So thinking about asset location of where you put those managers is certainly a key approach to use.
A related question to the idea of patience is, do you have any counsel about the entry point? One thing I know anecdotally in observing investor behavior is that investors often gravitate to managers after they see that streak of very strong returns. My sense is that that makes investors a little less patient because they really haven't enjoyed the good returns. They get on board after the good returns have already happened, and they tend to keep that manager on a pretty short leash.
Yeah, I know I'm subject to this too, right? We're looking for some sense of guarantee, some sense of concrete assessment that our manager is going to do well. And so a hot streak is, okay, well, they must know what they're doing and let me invest then, right?
Right.
As opposed to being strategic and qualitative about the selection process. Again, it's all, we're looking for some sort of framing or proof structure around that that is often we're susceptible to. And it's really a challenge we need to fight through. We often anchor on performance because it's the quantitative number that we can see and we can bank on, as opposed to the qualitative stuff, which is a little more ethereal.
Last question for you. Vanguard, obviously known for its index products, and we've seen investors very much embracing index products, very strong outflows from active equity, strong inflows into the passive products, especially exchange-traded funds. Do you think investors could be overdoing it? Are they perhaps overly enthusiastic about index products at the expense of active?
So it'll depend on your individual circumstances.
Sure.
The way we think about it, investment philosophy, is there's four things that matter, right? One is understand what your goals are. The second is think about a balanced or a portfolio that is broadly diversified, deliver that at low cost, and then be disciplined about executing that. So let's just step back from that and think about it. The interesting work that's been done on strategic asset allocation really identifies two components. One is that we often talk about this, that the cross-sectional variation in your portfolio, that's a pretty technical term,
right.
But the point is the variation in your portfolio is largely determined by your asset allocation. So getting that right first is really, really crucial. That's true. At the same time, however, asset allocation only determines 20 to 40% of your terminal wealth at the end, depending on your time frame and depending on your location. So there can be a role for active management in terms of outperformance, but we have to be really thoughtful about which managers we use and where we put them in which portfolios.
Okay, Daniel, important topic. Thank you so much for being here to discuss it with us.
My pleasure. Thanks very much.